I'm delighted to introduce our distinguished professor, James Foster, the Oliver Carr Professor of International Affairs and Professor of Economics at Elliott School. He's going to lead this dynamic conversation about what's happening in the finance world from COVID. So take it over, Professor Foster.
Will do. Thanks a lot, Joe. Well, how's everyone doing? I'm really honored to moderate today's GW Elliott School of International Affairs panel, and it's entitled The COVID-19 Impact on Global Financial Markets. I want to thank Dean Brigady and also the Dean's Board of Advisors for hosting this virtual panel discussion. Today's panel of experts are extraordinary examples of GW Elliott alumni who've blazed dynamic new trails as senior leaders in global finance. It's worth noting that many, almost 35% of GW Elliott alumni go on to pursue game-changing careers in the private sector, as we just heard. Today's panelists are three of the finest examples of this: Elliott alumni game changers in the world of international finance, and I'm delighted to introduce them. First up, you just heard from Julie Monaco, whose BA is 85, Vice Chair of the Elliott School Board of Advisors, Managing Director and Global Head, Public Sector Corporate and Investment Banking at Citi. Second, Marshall Parke, BA 76, member of the Elliott School Board of Advisors also, and partner at Lexington Partners UK LLP. And finally, my old friend Steve Skancke, BA 72, MPhil 78, PhD 81, Chairman Emeritus of the Elliott School of Board of Advisors, Chief Investment Strategist, Keel Point LLC, and Elliott Adjunct Faculty Member. Thank you all for sharing your expertise with us today. Now on to the panel discussion. Our time limits give us about, 3-4 minutes for each response. Our first question concerns the current state of affairs and future prospects. From your vantage points, can you give us an update on the health of the world economy and global financial system under COVID-19? How has your industry been affected? Do you think the recovery will be V-shaped, L-shaped, or W-shaped, or I heard today U-shaped? And will the global recovery be led by the developed world or by emerging markets? Let me turn it over to who wants to go first. I think I'll start with Julie.
Yeah, I'll start. The secret that the health of the world economy right now is not very good. We've never seen this type of drop. When you look at the World Bank and Citi house view from our economists and others around the world, we're talking about a 3% contraction in GDP. We're looking at GDP, the impact to GDP around the world being much larger than 2008. I know you're going to ask us later on to talk about the comparisons to 2008. As it relates to the impact on my industry, which is banking, the first 4 weeks of this crisis, it came on so furiously. Although we saw it coming, it was a slow freight train, and then all of a sudden the train got very, very fast in early March as the market started to tank. But basically, everyone had to go into overdrive to provide liquidity to the market. And so our industry really spent a lot of time reacting every single day over a 4-week period as the governments of developed countries around the world reacted with announcements both on the monetary counter this. Now, I think that in terms of the shapes, I'm not going to try to predict one of the shapes. I think that no matter what you predict, you're going to wind up revising it. If you look at a high level, we're going to need fiscal announcements at about 5% of GDP to counter the impact that this has had. Right now, so far, the announcements around fiscal stimulus has been around 2% of GDP. So there's a major gap from where we need to be to where we need, where we are today in order to really counter the negative impacts from it. I think that, one of the things that we really think about as we think about this crisis is that, you spent the first 4 weeks, like I said, trying to manage the liquidity side. And I think governments have done a good job in helping us manage the liquidity side. This is not a financial crisis. It is a health crisis that went to the real economy, and it will eventually become a financial crisis if we don't have the right responses. I'll stop.
Marshall?
Sure. Look, I'm not an economist, so I'm going to approach this really from what it looks like from inside the private equity world. And I think we need a little perspective on this. And so, I'd go back to 2016, 2015, 16, when the expansion that began in 2009 was already 7 years old. And the business cycle, historically, you've seen expansion and contractions with 7 to 10 year intervals. This administration came in, they decided, and for a lot of reasons, that they wanted to see a positive market and a growth economy, all of which are good things. And they lowered taxes, they deregulated, we engaged in huge government borrowing, and we lowered interest rates. We jawboned interest rates down. And, what that did was it put a huge amount of liquidity into the system. And in the private equity world, we watched multiple expansion. That's the multiple of EBITDA when you buy a company. The multiples expanded dramatically in the last 5 or 6 years. And everybody in the industry knew what was happening. They knew at some point that this had to come to an end, but you really felt that you didn't want to miss out on it. And so the way the private equity industry dealt with it, most of the big firms dealt with it, was they engaged in strategies that they considered to be defensive and anti-cyclical. And at the same time, they raised a ton of dough. So when this thing hit, you had the private equity industry had gone out and raised $4 trillion between 2012 and 2019. They have between $2 and $2.5 trillion of cash, dry powder that's yet to be spent. They think they have a better portfolio today on an overall basis than they had in 2008 because they have been relatively conservative. And so now they're looking at their portfolios and they're saying, what are we going to do? And the first thing is that the next quarter will be devoted to identifying the companies that are in trouble and tending to their problems. Everybody's looking at their portfolio and saying, okay, we've got this bucket here, companies that seem to be doing reasonably well, companies that are just okay, and then there's the troubled companies. And the focus is going to be on the troubled companies. And in support of this, they've got analysts pounding away, doing 30, 60, 90-day cash projections, trying to figure out what's very little real guidance that can be given to anybody. So I think you're going to see for the next 3 to 6 months, you're going to see more money put into existing companies, restructurings, recapitalizations. They're not going to be able to take advantage of the buy opportunities, and to be honest, sellers aren't going to engage in sales probably before the end of the summer and the fall. And it's really, I think it's going to be the end of the year before private equity, particularly the buyout industry, is able to deploy large amounts of capital into new acquisitions. In the venture space, what you're going to see, somebody's already referred to the fact that startups are struggling. The rule of thumb used to be on a startup, you'd have 3 to 6 months of cash. Now they're talking about 18 months of cash on hand. If you're going to get through it, there's going to be down rounds, there's going to be crown rounds. It's going to be a mess for a while. And then, ultimately the stronger companies, I think, will come through. So that's a bit of the summary in terms of, developing countries versus, developed countries leading us out of this. the developing countries haven't yet seen the full impact of the coronavirus. We've had a couple of years of bad, difficult times. Their currencies have been hammered. I think that the developing world is going to be in for a very tough ride. And I think it's really going to, any exit on this is going to be led by the developed world, and take some time. So that's about what I have.
Thanks a lot. How about Steve, please, for an economist?
Thanks. Well, as to what's happened to the health of the world economy, it's been an extraordinary shift from I'll just say anemic expectations of global economic growth, estimated earlier this year to be about 2.9% global economic growth, to the more recent revised estimates of down between 1.5% and 3% for the year. So we're looking at a swing of 4.5% to 6% in global economic growth estimates. And I think it's fair to say that while those estimates are well constructed, there's so much uncertainty as to what's going to happen on the epidemiology side of this that it's really hard for anyone to know. Well, we look just at the U.S. in the last 5 weeks, we've had 26 million new jobless claims. That's more than the 21 million of new jobs that were created in the record economic expansion. The New York Fed's estimate based on weekly indicators shows second quarter U.S. economic growth on track to be down 11% on an annualized basis, and on a quarter-over-quarter basis, 40%. Those numbers are unimaginable, and maybe to the point that they're not even relevant for decision making, except for us to acknowledge that we went from a relatively strong economy to something that is just crazy.
The shutdown has led to an immediate.
So it's you say, well, how do we navigate in all of this? How do we have an estimate as to what a recovery looks like? Well, interestingly, the U.S. stock markets have figured out a way to look over this chasm to what they think the world will look like in 2021 and beyond. The fact that we have first quarter earnings coming in showing down 15 to 20%, and the stock market is going up, either that's living in another reality, or they're just not looking back, but just looking forward. Obviously, we're going to have some surprises on reopening, rebound, all of those things that policy mistakes that are going to affect financial markets and the economy. As far as the shape of the recovery, I agree with Julie. It's really hard to know, but I think it's going to be a shape that we haven't seen before, James. And I think it's going to be more like the Nike swoosh, where we come down, we have sort of a curved bottom. It's not a V, it's not quite a U, and then it's a slow path of recovery. I believe it'll be 2.5 to 3 years before we get back to the pre-crisis growth path in the United States. As to who's going to lead the recovery, as much as I'd like to think it'll be emerging markets, they don't have the money. Julie's certainly going to see that with the banking that she does of those emerging market economies. But the United States is going to have a $4.5 trillion deficit this year, and only by the fact that we can, we're the reserve currency of the world, can we finance that. And how that gets financed in emerging markets is to be determined. I believe we're going to need to see the IMF and the World Bank and large financial institutions get together and figure out a way to provide that. Otherwise, we'll just see further cavitation in emerging market economies and in poorer nations.
Thank you so much, Steve. All right, our second question takes us back 12 years to the last financial crisis. What are the similarities and differences between 2008 and today? Are there lessons to be learned from the previous crisis that are applicable today? And how can we evaluate the trade-offs between opening the global economy early and keeping it shut down in a more prolonged temporary coma to beat the virus? So let me start with Marshall this time.
Okay. I agree with Julie that this isn't a financial institution crisis. This is a health crisis, and that's the fundamental difference that I see. My take on the financial institutions is that so far we have not seen enormous stress. They're in much better shape than they were last time around. You get right down to the personal level. You don't see people taking their deposits out of banks and sticking them into government-backed money market funds. I mean, in the broader sense. I think there were certainly, again, in my business, there were a lot of lessons to be learned from the 2008, 2009 crisis. At that time, companies and valuations were hit really hard, and a lot of funds were down to 60% of their prior values by year-end 2008. You can expect the same thing. If you look at how these companies recovered, you saw that once again private equity is pretty resilient in terms of figuring out how to tackle the business world today. So I have a lot of confidence in the ability to recover from this crisis. I think the thing I don't understand, and we're getting to in this sort of temporary coma to beat the virus, is the issue of testing. It just doesn't seem to me that testing is complicated to ramp up. Allows us the tools to navigate to opening up. I've gotten involved in testing companies. I've been investing in antibody testing companies. I've been talking to people at Roche and Abbott and the rest. And the know-how is there, the ability to administer is there. The ramp up just really requires a commitment, and to me, that's where we're going to have to go as a nation, and that's going to have to help us to be able to have the tools to get out of this thing.
Agreed. That's a great comment. Steve?
Yeah, thanks, James. I think Marshall's pointed out some of the differences. I think the similarities is that what wasn't so much a balance sheet issue this time around will become increasingly a balance sheet issue within the business and financial community. There's certainly been a lot pointed out on companies leveraging up balance sheets, particularly larger ones, to spend the money on share buybacks. And that does create some vulnerability, which is a little bit akin to what we had before. But I think the fact that the U.S. economy was basically strong as we headed into this is a huge difference. One of the differences, too, is that the Federal Reserve was right on top of this. I mean, they had their playbook that they brought off probably before any of us were aware of it. And whereas the last time around they increased their balance sheet by $3.5 trillion, they're on their way to increasing it by as much as $8 trillion this time around. And there's been a lot of criticism of the Fed, and some of it's fair, but they certainly have been proactive, preemptive, and decided that they'll just do whatever it takes, that there's not a liquidity issue or a credit issue. and we can certainly have a lot of observation about it. But at a time when political bickering was slowing the fiscal stimulus and the things that the Congress and the executive are the ones that have to do, the Fed was certainly doing its part, and I think that will make a big difference. The other thing that's interesting, and it also bleeds into your last question, James, that you're going to give us in a minute or so, is really to look at what some of the other countries have done and what's been the result there and the impact that that has on leading us out of this. Sweden had a very different response to what the United States and others have done. And they didn't put it into a temporary coma. They didn't shut it down. And while they've had a higher mortality rate, apparently it's within acceptable bounds, and they may come out of this in a very different way, and that's something worth paying attention to.
I would agree with what's been said already, but what I think the way I think about it is that I don't see any similarities with 2008 at all. This is a completely different crisis and something we haven't seen before. But there were lessons learned in 2008 that were applied, which both Steve and Marshall both referred to. The monetary and fiscal, especially the monetary actions to provide credit backstops and provide liquidity. We realized from the last financial crisis, and if you saw how certain toxic assets performed during the 10 years after the crisis, there were potentially failures that happened because of liquidity issues, not because of solvency issues. So I think there was very, very quick action, and there were definitely lessons learned that helped us go from a market that was cratering in the beginning of the march to a market that was stabilized. You look at some of the statistics, in the month of March, it was like $85 billion, $83 billion left the emerging markets, right? And then starting the 16th of March, because I know I was very much involved in it, the emerging markets started coming back in terms of investing, issuing bonds, and with Indonesia being the first one and raised $4.5 billion. And then since then, we have just had a wave of emerging market bond issuance. The difference from last time is a few things. One is that the banks are very well capitalized, so they were willing. It didn't immediately turn into a financial crisis. Everybody's taken, obviously, reserves on their balance sheet for potentially loan losses that may happen from this, but the banks just aren't levered in the way they were the last time. There are certainly companies that are too levered, and there is definitely too much debt. When you look at the total debt in the world, it's like 322% of GDP is held in debt. We have, $87 trillion worth of government debt in the world, 40% higher than when we went into the last financial crisis. So the levels of debt at the government level and out in the market after 10 years of very low interest rates and everybody chasing yield certainly has, as Marshall referred to, there were, definitely, the multiples had gotten too high. But I think that there's going to be opportunities, certainly in the PE space, there's going to be opportunities. So there's going to be a phase two. Phase one is over of this crisis. We think of it in phases. Phase one was really just stabilization and liquidity. Phase two is going to be the stronger. We're going to start seeing a wave of consolidations that'll start happening at the end of the summer as part of this. So I think that also there's the answer around, what are the trade-offs in terms of shutting down the economy versus opening the economy. I think it's very different answers, and I have very different answers depending on which clients I'm talking to. And I'm covering developed market sovereigns, and I'm in contact with the Treasury Department and various, developed markets governments, as well as emerging markets. It's a very different story. In the emerging markets, when you talk about leaving the economy open, you are talking about them choosing between two different evils. Are they going to allow their population, allow this pandemic to rip through their population when they know their healthcare system is even less equipped to handle it than the United States, and they're watching the horror stories going on in New York City? Or are they going to close down their economy when they have a large portion of their population that can't afford to work one day or their family is not fed? So they could have massive starvation on their hands. So there is not great answers for the emerging markets. A lot of the emerging markets, when you look at the debt that the emerging markets have taken on, sovereign debt, they don't have the fiscal room. They can't make the and they've had pressure on their foreign exchange and their reserves, and so they can't do the things that developed markets made. So one of the things that concerns me most, and Steve referred to it, and we've been working on it for a month, is what is there's no natural credit and for sovereign emerging market debt, we were able to have those backstops at the central banks for all the private sector debt, but there's nothing out there. There's no natural place for sovereign debt, and the current tools that the IMF has at their hands are not going to be there. And despite the fact that there's been an incredible amount of issuance, the development community and the development there's been, $31 billion worth of sustainability and social impact bonds that have been announced by the development organizations around the world. It's not going to be enough to really curtail potentially a meltdown in the emerging markets. So that's something that we're really going to have to address. And I don't believe that the G20 announcement that just about the standstill on the debt for the IDA countries in Africa is going to really solve that problem. So we've got a lot of work to do there. We've had 52 sovereign downgrades since January, and that will continue. So that's something that concerns me, and something that we really have to focus on. So I think that there's no one answer. The developed markets and the emerging markets have completely different problems.
Thank you so much, Julie. Now for our final question, brings us right back here to the Elliott School. We've had two major financial crises in the last 12 years. What is the special role of academic institutions like the Elliott School in educating the public and affecting policy to make global economic and financial systems more robust? So let's start with Steve this time.
Well, James, I think that if we just look at how our communications culture has evolved over the last 20 years since the 9/11, the recession, what happened in 2008 and 9, and what happens now. One of the things that we observe is there has been, an increase in the partisanship, conflict between government and media, to the point that it's very difficult in public discussion to have good debate, reporting on what has happened, what are the lessons learned, what can we do next, what's actually what are the opportunities in front of us. And although some of that has crept into the academic community as well, and part of that is just, there's a hypersensitivity to getting information that you might view as critical of what you're doing or what you've done. But I think it's very important that academic institutions, and especially a place like the Elliott School that has a tremendous presence and reach into policymakers within the United States and abroad, to step up and augment its leadership in trying to understand what are the lessons learned, what are the policy opportunities. Maybe that's a code word for mistakes that we can do better at the next time around in addressing things like this. It's not like we're not going to have this again. It'll just come in with a different face. But it does go to basic issues. We have a tremendous opportunity just to speak to the parameters and likely path of this extraordinary monetary policy experiment that we're in. Having expanded the Fed's balance sheet from almost 900 billion to 4.5 trillion, and now doubling up once more to about $9 trillion. That's extraordinary. We don't understand how that can happen. And obviously, there's been discussions about modern monetary theory, but it's happened almost all within a partisan context. And for us to be able to address this and deal with it and see where we go and be ready for the consequences, I think that has to come out of academic institutions, and certainly GW would be among those that are key to being able to do that well.
So, I think that, and again, I stated it in the beginning when you say, what's the policy implications that this is another financial crisis? I don't agree that it's a financial crisis. It's not a financial crisis. It's a health crisis, and it's turned into an economic crisis. And when you sent this question yesterday, I thought through a dinner that I was at the World Bank 2 years ago, where every spring the World Bank issues their financial stability report, and I was sitting in on behalf of our CEO on a dinner that they had at a senior level, and they asked all of us around the table that represented different financial institutions, what was going to cause the next financial crisis. And we all looked at each other, and most of us were banks, and said, well, it's not going to be us. Because we're so well capitalized at this point, one is we're not going to cause it, and two, we're not going to be the first responder, because we don't have the power to be the first responder anymore, because the liquidity is all sitting in the shadow banking system. And so they make that comment all the time that the last financial crisis, all the Fed had to do and Treasury had to do was call the CEOs of 10 banks and call them down to Wall Street to figure out how they were going to respond to this. Now you'd have to fill Yankee Stadium to have to get that kind of power. So I think it's just so different than 2008. But and there were policy implications that came out of 2008, and there'll be policy things that will come out of that. So in 2008, it was all about how do we make sure that we don't have this moral hazard with the banks ever again, and how do we get the regulations in place to make sure that. I think that we're in a different situation this time, and depending on how this plays out, there will be different policy questions, and there'll be an important role for academic institutions to be playing on those new policy issues that will come up. The three that most come to mind is something that the G20 and the G20 was on their agenda, and it was on the agenda because of the shift in the economy towards a digital and a gig economy before all this started, which of course is now being very much impacted. But it was the issue around global taxation and how do we get to a fair global taxation? Because when you look at the amount of government debt that exists in an economy that we keep saying is a really strong economy, obviously something's not working. So I think that that's going to be something that is going, and are corporations paying enough taxes? If you look at any other financial, you come out of other financial crises, usually there's going to be some level of increase in taxation. So there's going to be a global debate around that. Two, it's going to be around, is there a moral hazard beyond banks? Depending on how this plays out, there's obviously already backlash about us having, how is it working out with the Small Business Administration? Who's getting the money? Who's getting bailed out? Should they be bailed out? How strong was their financials going? Were their financials going into this? Whether that's the airline industry, a month or two from now, it'll be the auto industry if this doesn't turn around. And you've also got the situation where, debates going on around the health of states, coming into this crisis. So I think that will be another policy issue. And then finally, the social safety net. And, we've never had a crisis that had this kind of really the floor being pulled out from so many people all at once. And what is the responsibility, public versus private, to provide a social safety net? So is the issue that we don't have a fair living wage around the world where people have enough savings to be able to weather the storm? And do governments have to be prepared to do more? Or should the private sector be doing more in terms of paying higher wages? I mean, I think that the fact that there's a lack of a social safety net in terms of, you look at, and I know that my friends around the world that I talk to in the emerging markets are absolutely amazed at seeing cars lined up for hours for people at food banks, and that they can't believe they're watching the United States of America in terms of that. And other countries even have less of a social safety net. So I think there's going to be different policies that are going to come out of this, because it's a different crisis than we've ever seen. And tests that we've been doing, you always wind up with regulations and thinking around what happened in the past. So every year we spend an incredible amount of resources in the banking industry to try to replay out a stress test of what happened back in 2008. And none of those stress tests, they all taught, we worry about cybersecurity attacks. We worry about, major wars in the Middle East that disrupt oil supply. We've stress tested everything 6 ways to Sunday, but no one ever thought to do a stress test of the entire world, being impacted by a healthcare pandemic all at the same time. So I think that going forward, we are going to be really just grappling with different policy issues that will be the fallout from this.
Thank you, Julie. Marshall, would you like to finish it all up for us now?
Sure. First, I'll just make a quick comment on the emerging markets. And, I just saw something that sort of caught my attention. Was the one advantage they do have vis-a-vis the developed world in the crisis is that they have much lower percentage of the population that are over 65, the vulnerable group. And I saw numbers said something like 3% in the emerging markets of the population are over 65 versus 16% in the US. I think it's closer to 20 in Europe. So to some extent that works to their advantage. What can GW do and the Elliott School do? I have a continuing complaint that what I see in business and in my business is a lot of people with great business school degrees, but very few economists and people with policy experience. And I would like to see GW and be able to overcome the hurdles that Ruben described a little earlier, and have the Elliott School work more closely with the business school to provide degrees that uniquely cover those areas, and so that we get people that do have training in economics and policy and can address these times. So that's my sort of contribution on that subject.
Well, great. A wonderful panel for all the wonderful insights that you've presented to us today. I'm going to turn it back over to Joe. Go ahead, Joe.
Thank you, James. Thank you, Marshall, Julie, and Steve for your extraordinary content. It was excellent.